Okay, now let's talk about liquidity. Liquidity is the last concept that we are going to dive a little bit deeper into, and then we are going to talk about entry model, then we are going to talk about market maker models. That is coming tomorrow, but it's important to understand liquidity because liquidity can come in many different ways. It's structural liquidity, time-based liquidity, and then how we are going to use it, right? But first, we have to understand liquidity itself, structural liquidity, because liquidity can be divided into two. It's external range liquidity and internal range liquidity. Just like we talked about the fact that the structure, the market structure is external market structure and internal market structure. The same thing happens with liquidity. And who would have thought they actually correlate, because external range liquidity is going to be at the areas of external market structures. So you can see right here, these are going to be the areas of external range liquidity. And then internal range liquidity is that while we are forming these highs, there's always going to be pullbacks, there's always going to be wicks. And one of the things that you have to understand is that liquidity is resting orders. Every time that there is a buyer, there needs to be a seller. Every time there is a seller, there needs to be a buyer. Because the market is efficient. That's how the market moves. The market is a zero-sum game. Doesn't really matter. That's how the market moves. There needs to be liquidity. And the way we use liquidity, the way we see that is through highs and lows. We assume that those are resting orders. People that entered in that area, they are going to be trailing their stops above the highs and the lows. That's where people usually put it at. And that's where we are going to put it too, right? But that's because we are going to use protected liquidity. For example, if we were to take this trade, we would have put it below this low, because if the uptrend is to continue, then you don't expect this low to go, right? It's going to be a strong low. But external range liquidity and internal range liquidity, what you have to understand is that external range liquidity is always the overall draw of the market. It takes more time to pan out, while internal range liquidity, it's the easy draw of the markets. It's the easy targets for the market. It's the tiny equal highs on the 5-minute, on the 15-minute that we are going to see. Those are extremely easy to target, and the market is very likely to go to those and then give us a reaction on wherever it wants to go. So liquidity, internal range liquidity, is always going to be where our targets are. This is the problem. I see so many people fail because they always target external range liquidity. And if you take one thing from this bootcamp already, is after all these things that you've already taken away from the bootcamp, is always target internal range liquidity. Never target external range liquidity, because the extra 0.3 R that you are going to get are not worth the probability of the trade not going to external range liquidity. And yes, most of the time it will, but the one time that it won't, you will see that it's not worth it giving all of your profits back just because you wanted an extra 0.2 R. So again, structural liquidity is internal range liquidity and external range liquidity, the swing highs and the swing lows, and the internal highs and internal lows. We have here a quick example of the market with two external range liquidity, and all of this is internal range liquidity. The market comes all the way to the upside, sweeps, come towards this high, and then eventually we have a very nice market shift right there. And this, by the way, if we have a bearish bias, is going to be one of our entries. And then the market starts moving to the downside and taps the other external range liquidity. So once again, these were very quick levels that the market wants to tap and then move to the downside. Now, we have also something called time-based liquidity. Now, in order to introduce time-based liquidity, we need to introduce sessions. So sessions, the reason I want to talk about sessions in this specific one is because I seriously despise people that are like, oh no, the daily candle doesn't start when TradingView starts it. The true open is at midnight Eastern Standard Time. That is not true. That is simply not true. Because if that was the case, then the market would start at midnight Eastern Standard Time. I don't care whatever anyone says. I don't care if that person says they have the algo. You have to understand that the market, the true market does not start when it's midnight in New York. It's not true, right? So you trade what is in front of you. Stop making trading complicated for yourself. That's why I'm doing this bootcamp, is because I'm tired of people overcomplicating simple stuff because they want to sell you on something, right? So we're going to look at the daily open, which is at 6 p.m. Eastern Standard Time. The daily close, which is at 5 p.m. Eastern Standard Time. By the way, this is on futures. London session is going to be from 3 a.m. to 6 a.m. Eastern Standard Time. And New York session is going to be from 12 p.m. to 2. And also, I forgot to put it right here, from 9 a.m. to 11 a.m. EST, right? These are going to be our sessions. We have the AM session and we have the PM session. Literally, that's when traders trade. There's a lunch hour that happens in New York session. That's what we are trying to avoid right there, right? So that's why we have the lunch hour, right? So New York session is divided into two, and then we have the time-based liquidity that is going to be the daily highs and daily lows, session highs and session lows, weekly highs and weekly lows. So all of this is just giving you points of liquidity. Now, the way we pair liquidity with other concepts is, for example, the power of three. Why do we use the power of three? Is because we want to see the traders that are losing money. So let's say that we have New York session, right? We have New York session open, and the market starts ranging, and then it goes to the upside. And there's also London session, right? This is London session high, meaning the high that happened between 3 a.m. and 6 a.m. Eastern Standard Time. Now you know that every single New York trader and every single London trader is losing money, and it was very likely liquidated because they had their stops above London high. So if we then start moving to the downside, that's when your alarms have to ring like, oh my God, we are moving down. It is time to execute. That's all we have to do, is understand that what does this mean? Liquidity simply means stops getting triggered, buy stops, sell stops, stop losses, sell stops, buy stops, which means entries, stop losses getting triggered. All of this is happening and it's generating liquidity. That's why the market has the power of three. That's why we have market maker models, which we are going to talk about tomorrow. Right? So daily highs and daily lows are very, very key points. Why? Because that's where traders that traded the day before are going to trail their stops. So if this is a specific daily high and the market moves higher, that means that every single person that shorted yesterday is losing money. That is a key level, and you have to remind yourself of that. Then we have session highs and session lows. And by the way, if you don't want to do all of this manually, there's indicators that do it all for yourself. If you want, in the resource tab of this course, I can put that there. So check the first link in the description. It's completely free to get all of the resources. So then we have session highs and session lows. Why? Because the traders from that specific session are losing money, and we have weekly highs and weekly lows because swing traders now are losing money too. So that is what we mean with time-based liquidity. Now, how are we going to use all of this? We are going to use all of this for targets and for patient, because while liquidity is not taken, very, very likely it's not a high probability scenario to trade from. But then also targets, because as we saw right here, if your daily bias is bearish and we've just swept bullish liquidity, meaning all of the buy stops here were triggered, so all of the stop losses that were up here were triggered. So anyone that entered in the shorts right here got their stop losses triggered. Anyone that was trading breakouts got their buy stops triggered, and now they're all losing money, right? So this is almost like, hey, everyone is going to be selling. Why? Because all of their buys were triggered, and if you want to exit your buy, what do you have to do? You have to sell. And that's what I mean with liquidity. Now, let's quickly go onto the charts and let me show you a few more examples. So here we have an example that is basically happening extremely recently, where we have a lot of range-bound price action. And what do we have? In this case, we have liquidity up here and liquidity resting down here. Every time that the market starts pulling back, you start thinking, okay, what is the high, what is the low, and which one is going to be targeted? And that's when we see that the market comes towards this high. All of this is manipulation to then move to the downside range and then continue moving to the downside. If we come all the way up here, we will see this happening over and over again. Do you think that it is a coincidence that the market sweeps the high before the close to then move to the downside. This is not a coincidence. This is generation of liquidity. Same thing right here. High gets taken, market actually moves, right? We can see this happening over and over again. And that's why the highest probability trades are going to happen when we have liquidity in line with our bias. That means that if we are heavily bearish, you wait for a high to get swept, especially if it's a session high, especially if it's a previous day high to get swept before we move to the downside. You can see this happening over and over again in these markets. It is just absolutely beautiful. So if you want to improve your edge, liquidity is the way to go, right? You need to target liquidity. So all of this, what would you be doing? The reason I say that liquidity is going to be used for targets and patience is because, look, what is your target? Your target is going to be this low. But while the market doesn't sweep any sort of highs, then you're not interested, right? Because that's when you need to have patience. That's when you need to wait for traders to be losing extreme amounts of money to actually get liquidated, to stop getting tagged before the market then going to the next pocket of liquidity. Because that's what the market does. The market moves from pocket of liquidity to pocket of liquidity, right? Same thing here. As the market is pulling back, you're patient until we have the sweep, boom, market shift, and then the market starts ranging, then we move lower, and then we target the low. Right? We target the low right there. So that is what is important for us to understand. Liquidity is crucial in the markets. All of this is generated liquidity. All of this is generated liquidity. People buying, people selling, people buying, people selling, putting their stops above highs, above highs, above highs, to then get tagged and then the market actually giving you the true move. That's what you want. Same thing here. Range. Liquidity is swept, big market shift. Okay, this is the point where you can start looking for longs. Boom, there you go. Right? So, if you understand liquidity, you will be able to understand every other thing that we are going to talk about now in the near future. Right? So structural liquidity can be divided into two: external range liquidity and internal range liquidity. Just understand that mostly you want to target internal range liquidity because those are easy targets, while if you want to go for bigger risk to reward, you target external range liquidity. But personally, I do not think it's worth it. External range liquidity is one of the reasons why so many people are unprofitable. So with that being said, that is liquidity for you all. Now let's dive deeper. Let's dive into market maker models and then go into the entries. Hope you enjoyed this lesson. Click right here to watch the next one. And if you are struggling with overtrading, then click right here to check out Trade Blocker. Peace.